Hello and welcome to REFM's Identifying Risks and Opportunities in Commercial Real Estate. This is Bruce Kirsch, founder of REFM. If you would like to and have not done so already, you can find the slides for this content on the Materials tab of the course lesson page. Let's go ahead and get started on slide 2, which is our agenda. First, we'll talk about the risk-opportunity bargain and investigate the spectrum of risk across different commercial real estate investment strategies. We will then identify the primary risks and whether they can be mitigated. And an opportunistic strategy example would be ground-up development, or if you have the balance sheet as one real estate company to buy another real estate company. Using ground-up development as the example, the strategy here is naturally you're providing new supply to the marketplace, and there's a lot more risk involved there than there is in buying a stabilized asset in an established market. Common across all of these strategies are the general tactics of improving the income stream, streamlining operations, perhaps, to lower operating expenses, pursuing a favorable real estate tax reassessment to lower your real estate taxes, just generally speaking, lowering your costs. In the instance of expense increases, which are inevitable, the tenant will continue to bear those expenses on a pro rata square footage basis naturally. So they would bear the base amount as well as the increased amount in future years. There is a possibility that the tenant negotiates an expense cap wherein they would only bear up to a certain amount, after which the landlord would then bear those expenses. And so this is one of the major structures that allows landlords to shed operating risk onto their tenants, remaining occupancy but rent non-payment in the case of bankruptcy. So there's no right answer as to what percentage of my building should be the maximum percentage that goes to, let's say, financial services. And that is part of the risk of being a landlord, is making those subjective selections. Should you let them take 60% of your building, or should you only allow them to take 40% even though they're willing to take 60%? The numbers that you're running are most likely wrong, and they're most likely low. So if we take a look at this graph, this shows the general trend of construction costs. One is the Turner Index, which is related more to the inputs for high-rise construction. The other is the Lineman Construction Cost Index, which is more suited towards mid-rise, which can apply to multifamily, garden apartments, etc. And so the trajectories are pretty clear. And again, if it's going to be a span of years between when you are running your pro forma for the first time and when you're signing that GMP, Guaranteed Maximum Price contract, let's say, there's a lot that can happen in that span of time in terms of cost inflation. This is the general dynamic that has been experienced over and over again in the commercial real estate markets. And what's happening as rents are rising is developers are entering. And so here's the big correction that we were referring to before, and things recover over time, but it was certainly a massive shock to the US market and rippled globally as well. And so if we take a look at where we are now in the US, it's the red line here, we see, right, even though there was that major correction, it did come back, and housing prices are not quite back to where they were at that very frothy time in 2005, 6, and 7, but they're coming back.